Growth shares. What are growth shares? Growth shares isn't a technical term, but refers to a tax-efficient means for employees to acquire an interest in a company without a substantial initial outlay. Growth shares are a good option where an EMI or CSOP is not available and the employer would still like to offer a tax-efficient option. With a growth share scheme, a new class of shares is established, which participate in the company above a certain value. This value, often referred to as the hurdle, is typically set at the current value of the business. The growth shares only gain value as the company grows beyond the hurdle. Why might we want to consider growth shares? Because the hurdle is a level generally equal to or just above the current market value of the company. The value of this new class of shares is usually quite low, making them a more affordable option for employees to buy shares outright. Another benefit of growth shares is that because employees purchase the shares at full market value, they avoid income tax and only pay capital gains tax on exit. In some circumstances, it may be possible to qualify for entrepreneurs' relief. With growth shares, employees can also benefit from shareholder status, meaning they can get the right to vote, and they can also receive a dividend, which is not something granted by options. Employers also benefit. Growth shares provide a compelling employee incentive. The more the company grows, the higher the value of the shares. When do employees receive the money from shares? With growth shares, employees can either receive money on exit or at a certain event. In most cases, when the shareholder sells the shares, they would receive the increase in the value of the shares after they have been issued, the difference in the value when the shares are sold and when they are first acquired. Alternatively, the shareholder may receive a certain value when certain performance targets are reached. This setup is less common. Would growth shares be good for our company? Growth shares are best suited for privately owned companies who have good potential for growth, or where the current value of shares is too high for employees to afford full market value. What are the disadvantages? The main disadvantage with using growth shares is that, unlike cash bonuses and EMI options, the gain on the shares cannot be treated as tax deductible. Growth shares can often be expensive to set up as they will always need to be customised to the individual company, and the initial valuation can be complex. Generally speaking, implementing growth shares can be a complex process, and this is often something that discourages companies from participating. How do we go about setting up growth shares? The first step of setting up growth shares would be to approach an advisor who would be able to do a diagnosis of the nature of the company, how much it costs to implement growth shares, and how this can be worked into your business model. How can we find out more? If you'd like to find out more about what kind of share scheme might work in your company, we have a number of additional short animated tutorials that will give you the information you need. Postlethwaite are a law firm specialising in employee share ownership. We are employee owned ourselves. Get in touch.